QuickBooks Online 2021. Recurring transactions related to adjusting journal entries such as depreciation expense and prepaid insurance. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our QuickBooks Online practice file. We're taking a look at reoccurring transactions. Going to the cog up top, we're going to go to the list items. We're looking at the recurring transactions list. These are the recurring transactions we have done thus far. We see the types here: invoice, bills, expenses, and so on and so forth. Now we're going to be taking a look at journal entries. So to consider the journal entries, let's jump on over to the QuickBooks desktop just so we can consider it in context. You don't need to have the QuickBooks desktop in order to follow along. We're just taking a look at the flowchart. So in prior presentations, we looked at the memorizing of the transactions or recurring transactions for the payable cycle, including bills or possibly check forms or expense forms, which are pretty clear as to how those might fit into the cycle. And then we had the revenue cycle, where we looked at recurring transactions for invoices or sales receipts. Now we're thinking about basically the end of the process, those being the adjusted entries, those entries that we typically might have to put in place in order to adjust our books to whatever accounting basis we are using, typically the accrual basis. We call those adjusting entries, done periodically, typically at the end of the month and or end of the year. Those include things like recording the depreciation expense or prepaid insurance. Some of those can be standardized, and therefore we can use the recurring transactions in order to deal with them as well. So let's go back. So also just note that we don't have a standard form for these kind of journal entries, because they're not something that happens on a day-to-day process, but are adjustments that happen periodically. Therefore, we use the good old debit and credit journal type of form. All right, so let's gonna close this back out, and we'll think about our two types that this could fall into. One, depreciation, recording depreciation, which sometimes can be somewhat standardized, especially if using straight line depreciation. And two, say a prepaid type of item that we put on the books as an asset and then record part of it over time, most commonly used, or the biggest example of that being prepaid insurance. So we'll take a look at those two items here. Let's start off with the equipment. So first, let's open up our reports, balance sheet, and income statement. Going to go to our drop down, or our tab, not our drop down, the tab, right click on it, duplicate it. I'm going to duplicate it again so we can open up the balance sheet and income statement, right click on it, and duplicate again. So we're going to be opening up the good old balance sheet and then the income statement, otherwise known as the P&L, profit and loss. We'll do that by going to the reports on the left-hand side, opening up the profit and loss report. I'm going to change the date range. Actually, that's okay. It's in the current year, 2020. Closing up the hamburger, I'm going to go to the report to the left now, open up the balance sheet by going to the reports on the left-hand side, opening up the BS balance sheet report, and then I'll close up the hamburger for that one. Now we're going to first record the asset on the books for our depreciable asset. So we'll record something here that's going to be depreciable, and then we'll do the depreciation related to it and standardize that or make it a memorized or repeated transaction. Back to the first tab, I'm going to hit the plus button to put this equipment on the books. We're going to say we're going to purchase something. Let's do it with an expense form, and we'll just purchase it with cash here. Just put the equipment on the books, so this will kind of pull together. I won't even put a payee. I'll say it's a check, and we'll say this happened on 12/31/20. And I'm just going to call it, the category is going to be equipment. Now I'm looking for a fixed asset type of category. Let's say equipment. We don't have equipment. I'm just going to call it equipment. I'm going to set it up, tab. It's not going to be an expense, and this is the key. We're going to put it on the books as basically an asset, of course, because it's going to be a large piece of equipment, and then we will expense it in the format of depreciation. So we'll put it on the books as an asset. So it's going to be a fixed asset. There we have that. Looks good. And we'll save it. And we're going to put it on the books and say it's $20,000 piece of equipment. So we're not going to expense the $20,000. It's too large. It's going to be impacting multiple periods. So we're going to say save it and close it. Check it out. Let's go back to the balance sheet and refresh it. And hold down Control, scroll up just a bit. We then see our 20,000 in equipment down here. So now what we want to do is record the depreciation for it and try to standardize the process of the depreciation. To do that, we will estimate that the depreciation will be, let's say, a straight line depreciation for 5 years. So if I was to say, all right, let's pull out the trusty calculator then. Trusty calculator for doing calculations. I want to calculate with the trusty calc, and we're going to say this is going to be then 20,000 divided by 5 years. That's times. 20,000 divided by 5 years would be 4,000 a year. So we could put a recurring transaction at 4,000 a year, but we might want to do it monthly. So if I divide that by 12, we're talking 333.33 a month. So that's what we'll look into. We'll say that's going to be the 333.33 per month recurring transaction. So I'm going to then go back up top here, go to the first tab, and let's say I'm going to say plus. And this time I have to go to a journal entry. That's the normal transaction we use here, journal entry. We're going to debit depreciation expense, standard depreciation journal entry. Depreciation expense. And I'm going to set that up, and we'll say that this then will be a debit to a expense account, depreciation expense, and we'll just say other here. So depreciation expense, save it and close it. And then I'm going to say this is going to be for 333.33, description adjusting entry, I'll call it. And then the other side is going to go to accumulated depreciation, which again, we don't have set up yet. So accumulated depreciation tab. And I spelled it wrong. There we go, tab. This is going to be a fixed asset type of account. And I'll say this is going to be accumulated depreciation. There we have it. And save that. That's our standard kind of a journal entry. And this one's as of 12/31. Now, I'm going to make this a recurring transaction in a similar way we did with the forms down below and try to record this every month. So I'm going to go down here and say make recurring. And so it's going to be a template. Now we could either schedule it or have it as a reminder. So if it's a recurring transaction, we know it's going to be the same, then we might simply record it, just schedule it. If it's straight line, it typically will be the same, but if we're using some other kind of depreciation or possibly talking to our accountant to help us out with the depreciation, that they might record and we're just going to record what they have because they might be using tax depreciation, or we might have double declining balance, or of course we might have more than one piece of equipment. So the depreciation might not be standardized each month, but I do know that we need to do a journal entry for it each month. So maybe I use this as a reminder so that I can then see what the journal entry should be, debit this account, credit this account. It could be more complex than that as well if we had different categories of fixed assets, and therefore we can kind of save the format of the journal entry. And then when we need to record it, we can just adjust the numbers to whatever numbers need to be used, possibly those numbers provided to us by the accountant who has the depreciation schedules using the tax software or something like that. They can give us the actual numbers. I'm going to say 1 here, and normally we would record this monthly or possibly yearly, typically monthly. I'm going to do it daily just so we can then check it out in the future and see what it would look like. I'm going to put the current date, 02/22/1, and then none here, and that's going to be our transaction. Now I'm going to save it as a template. As I save it, it's not going to record anything, but simply save the template that will then record it later or help us to remind us to record it. So I'll say save it, and something's wrong. Please enter a reoccurring template. So I'm going to call it depreciation, let's just call it depre, that'll work. Save it, and there we have it. So now I'm back in my recurring transactions. This is, of course, at the drop-down lists, recurring transactions. We can then see here now we have a journal as one of our account types. We could sort these transactions by going to the filter up top. For example, this one we set up as a reminder. So I'll say reminder and then apply it. And now we have invoices, bills, sales receipt, expenses. Here is our journal that will be a reminder. The fact that it is a reminder means that once the time has passed, it will create a reminder item in our reminder list. and then we can go to our reminder list and pick that up, which we may do in a future presentation. Also note, if I go back, the fact that it is a reminder means that we know that it's going to happen periodically each month, but we may not know, again, the exact numbers, and that means we can change it once we're reminded to do so, and we'll have the same format to enter the data. So also note that I didn't record it. It didn't record the actual journal entry that we put in place. If we wanted to record it, I can hit the drop down and say, use that item, and then say I want to record this one as of 12/31/2020, for example. Let's actually record that item, save it and close it, and say yes. And so now I'm going to go back to the balance sheet, run it. And so now we've got on the books, we've got the equipment, and we got the accumulated depreciation. That would be like after 1 month of activity has then passed. So that means the book value is at that 19,666.67 at this point. Now, again, you can imagine this being more complex because we could see equipment account, we might have an automobile account, we might have, improvements accounts or something, a building account, and then we could have accumulated depreciation related to each of those categories. So in addition to having it record automatically each month, it might help us to save the template of the journal entry that we will have, and there, once again, get the information possibly from the tax preparer who might have the depreciation schedules to help give us the actual numbers that we can then populate in our pre-formatted journal entry that we're using as kind of like a reminder. If I then go to the tab to the right and run this report, then now we've got our depreciation for the one transaction that we recorded. Should be down here somewhere. If I refresh it, I got the wrong date. Let's put this back to 01/01/20 to 12/31/20 and run that. So there's our depreciation expense we recorded, and then we got our memorized transaction for a reminder in the future. Now let's do the one for insurance. If I go back on over here, this would work for any kind of prepayment. It's a similar process as we think about for the equipment, but let's say we prepaid insurance. We paid insurance for a year's worth of insurance. If I was to expense it, then of course it would look kind of funny because I'm writing off the expense for the full year in 1 month. And if I was to compare that month to the following month, it wouldn't be fair because the following month is being benefited by the insurance that was paid for in the prior month. Therefore, we should put it on the books in a similar way as we did with the fixed asset as an asset of prepaid insurance, and then record the expense as that asset's being consumed. And that would be so as the time passes, we would record the expense in that format. So let's take a look at what that would look like. Similar process. You can do this for anything that's like a subscription. So if you had software, for example, QuickBooks or something that you paid 12 months in advance for the full 12 months, and it would be more proper to record it as, prepaid for the software and then record monthly the expense so that when you look at the income statement, it has a fair representation of the expenses that you have consumed, not the cash basis in that format. If you prepaid the rent in that way, same kind of concept. Insurance is just the most common example because by definition, you always prepay insurance. So let's go back on over and let's say that we're going to say another item and we're going to buy the insurance this time. I'm just going to put it on the books as an expense. And we're going to do it a little bit different than what we did with the insurance before. I'm going to say insurance prepaid. This is the vendor name just to distinguish a different vendor. And let's fix it. Insurance prepaid. And then we're going to put it on the books at 12/31/20. And then I'm going to go down here. And instead of putting it into insurance expense as we did before, insurance expense, it's an expense account here. That might work well or be fine if we pay it every month. And it's a monthly kind of expense, even though we're paying basically before the month happens, typically with insurance. But if we pay for an entire year of insurance, which is quite common because we might get a discount for it, then it would be more likely we should put it into prepaid insurance and do it this prepaid thing. So that's what we'll do here. I'm going to say insurance, let's say prepaid insurance. Prepaid insurance. There we go. Now this is going to be an other current asset type of account. So we'll say this is going to be an other current asset. It's going to be some type of prepayment, prepaid expense, prepaid insurance. Putting that on the books, we're going to say let's put it on the books for $12,000 and imagine that was for 1 year's worth of insurance, meaning if you break it down to per month, it'd be $1,000 a month. So we're going to save it and close it and say yes. Let's check it out. We're going to go down to the balance sheet or back to the balance sheet, scroll up, run the report. Now we've got prepaid insurance. We paid for a 12-month plan, $1,000 a month, and we paid for all of it in this time period, so $12,000 up front, but we haven't consumed any of it because no time has passed yet since the purchase. Nothing then is going to be on the income statement. Now we'll do the adjusting entry, which would be to debit debit insurance expense for the amount that we consumed and credit the prepaid insurance, and we can make that automatic because it's going to be the same amount, $1,000 each month. So we can just make that a standard automatic transaction. Back to the first tab, let's do that. We're going to say, let's hit the drop down, make it a journal entry. And standard journal entry then would be insurance expense. This is going to be our expense form now. And we're going to say it's going to be for $1,000 because it's $1,000 a month. And then I would put the description would be ADJ, adjusting journal entry, insurance, something like that. And then the other side is going to go to prepaid insurance, and this will decrease the prepaid insurance amount there. So decrease the prepaid insurance, put it into insurance. We're going to make this a reoccurring transaction because we can do this for an entire year. So I'll say make it reoccurring, and we're going to call this insurance ADJ. This time we can just schedule it. I can make it scheduled or a reminder, but this one's going to be automatic. I know exactly what it is. I don't have to change any numbers. So possibly this one I just schedule it. Just do it without me having to double check it. I'm going to say 1 here. And then down here, most likely we would then be choosing monthly, of course, monthly. And then we might have an end date because we know the insurance policy lasts for 12 months. So this one we would probably want to set that end date and say, do it automatically for 12 months and then end it at that point. And that's how we could set it up. But we want to see it shortly. So I'm going to say I want to do it daily just so I can check it in a day. And we can look at what happens. And we'll put the current date 02/22/1. And then again, we would probably want to set an end date here, but I'm not going to do it for our example. I'm going to record this, and I won't actually record it. It'll save it as a template when I save it. If I want to record it, then I can go back into that template and then basically record the current transaction, and then the next one will happen according to our schedule. So we'll save it and say yes. And then if we go back to our templates, we can hit the cog drop down, lists reoccurring transactions. I'm going to close the hamburger, and I'm going to close the filters. This is all the reoccurring transactions. And of course, now we're looking at our journals. Here's the 2 journals. We can then sort by, if I hit the drop down, let's sort by the items. This time we have one that is simply scheduled, not as a reminder, but simply going to be scheduled. Apply it. There we have our invoice. There's our journal, bill, sales receipt. Here's our journal in that format. That means that when this becomes due, it's simply going to record the transaction rather than putting it up top as a reminder. It's just going to do it. It's just going to record it. And that's going to be the schedule there. We can also filter. If I hit the filter, all, and this filter by journal now. Let's filter by journal. So now we have our 2 transactions here that are journal transactions. One a scheduled transaction, the other a reminder transaction. The scheduled transaction will be one that will, the reminder transaction will be one that will be up here in the reminder list once the time has passed, which we'll see in the future. The scheduled transaction will not. It will simply record the transaction once the time has then passed. Now again, if we wanted to record this adjusting entry, I can hit the drop down here and say I want to record it now. I want to record one now. I'm going to say use this transaction. And I'm going to record it as of the same date. So now it will record this transaction. So I'm going to save it and close it. Save it, close it. So now it's still in here. So it's still going to basically do it again at the next date, which will be a day for us. So we can go check it out. And now I can see what's going to happen. If I go to the balance sheet, scroll up top, run the report. There we have our prepaid insurance is down to $11,000 now. Scrolling into that. If I then take a look at my date range of 01/01/20 and run this report. So now we put it on the books at 12,000 and we imagine like a month passed, even though we put it on the same day. 1,000 goes down, 11 months left, 1,000 times 11. is the 11,000. Scrolling back up, and there's going to be our 11,000. Notice this is the same concept we used down here, except that with the equipment, because it's an estimate, it's not something exact, then we kind of made an estimate account up top to record the decrease instead of just hitting the account directly, so that we tell the reader, here's the cost, here's the amount that it went down by, here's the book value, as opposed to here's just simply kind of like the book value, because we know exactly what it is here, because there's no estimate that's going to be involved. And then on the other side, we're going to say, okay, let's run this report. Now we've got the insurance, the 1,000 that's been recorded. This one was recorded with the journal entry that we made. Scrolling back up top. So there's going to be those two transactions. We may go back into this in the future and just see the automatic transactions that might then apply out for when we look at the reoccurring transactions related to the journals as time passes.